Welcome to the Note Nuggets podcast, where you can learn how to become the bank, build wealth, and accumulate streams of income perfect for your savings or IRAs. You'll hear from industry experts, seasoned veterans, and everyday investors. Our goal is to teach you how to invest in notes, one nugget of knowledge at a time. Here's your host, Kevin Galang.
Welcome, everyone, to another episode of the Note Nugget podcast, where you learn how to turn other people's debt into income for your savings or IRA. When people talk about residential mortgages today, they're generally referring to amortizing mortgages. With an amortized loan, the borrower pays the lender in regular monthly payments, and the payments get broken down into principal and interest payments towards the loan amount. Then over 15, 20, 30, or even more years than that, the loan gets paid in full. These types of mortgages are in abundance in the market today. If you're buying a house and financing it through a banking or lending institution, chances are you'll receive a fixed rate amortizing loan. But there's another type of mortgage out there that exists. This is where the borrower pays the lender only interest payments, and then when all of the payment is due, that's when they pay the lender in full. These types of mortgages are appropriately called interest-only mortgages. When I first heard about them, I didn't understand why this would be a good strategy, but after educating myself and creating the right deals, I originated 3 interest-only mortgages in my self-directed IRA. For this episode, I wanted to share with you 3 things to consider when thinking about originating or buying interest-only mortgages in your IRA or savings. If you're curious about exactly how I'm using mortgages to grow my IRA and how I've helped investors create cash flow and wealth through notes, book a time on my calendar at notenuggets.com/contact and let's get your money moving for you. As you all know, I'm a risk-averse investor. So I always start with how well am I or my investors protected if the borrower is unable to pay? That being said, the first thing I consider when thinking about interest-only mortgage is what is my collateral and how much equity protection is there. This is absolutely a key thing to consider when investing in an interest-only mortgage, because when that principal payment is due, you better hope that the borrower will pay you all of your principal in full like they're contractually obliged to. I don't know about you, but I don't know many people who have thousands, sometimes tens, or even hundreds of $1,000s in cash laying around. If they don't have it now, who's to say that they'll have it in the 5, 10, or 15 years when the note term is done? So when it's time to pay the piper, and the borrower isn't unable to pay you back, you're well protected by the asset. Here's an example. One of my loans in my self-directed IRA is for $55,000, but it's protected roughly by almost $300,000 in equity. Well, I want my borrower to succeed. If they don't, I can sleep at night knowing that I would make a home run of a profit. Now, speaking of the borrower, that's the second thing to consider with this type of a loan. Who is your borrower? As I mentioned before, the borrower is legally required to pay you all of your principal back at the end of the note term, which might be 1, 5, 10 years, however you want to structure that with your borrower. So if you're investing in an interest-only mortgage, your due diligence should reflect on how well your borrower will be able to repay that principal amount when the time comes. I think interest-only mortgages are riskier than amortizing mortgages because the success of the interest-only mortgage heavily depends on whether or not the borrower has the money for the lender at the end of the term. It's not that I don't trust my due diligence process, nor am I doubtful of any of my borrowers, but I know that life happens. Things come up, and any performing mortgage can go into default. And in the case of an interest-only mortgage, there are 2 types of ways that the borrower can go into default. If the borrower doesn't make their interest payment, the note goes into default. Or if the borrower cannot make the principal payment at the end of the term, that performing note is now in default. However, I recommend this as a second priority, as the quality of the collateral will really ensure your protection as the lender. The third and final thing to consider for an interest-only mortgage is why you would do it. From a borrower's perspective, it's a lower payment. My borrowers only pay me once a year. But if we were to break up that interest-only payment into monthly interest payments, it would be significantly less than a principal and interest payment of an amortizing loan. Now, I don't know what my borrowers are doing with my money. Frankly, it's none of my business. I'm assuming that with this low expense, they're using my money for things that will yield them higher interest than what they're paying me. Think of this similarly to how banks borrow money from the federal government at super duper low rates and then charge higher interest rates to their borrowers. They're creating a spread on my money for themselves. From my perspective as a lender, everything is easier. The principal balance doesn't change. They owe me that $55,000 until it's all due. That's the unpaid principal balance at any time throughout the life of the note. The best part about these interest-only loans is that I'm projected to make more money than an amortized loan. Don't believe me? Well, let's do the math. If we take the $55,000 loan I mentioned earlier and say it was at a 10% interest rate amortized over 5 years or 60 payments, the total interest from this amortized mortgage would be just above $15,000. So after 5 years, I would have a total of roughly $70,000. But if we take that $55,000 and create an interest-only mortgage with 10% interest over 5 years, then the amount of interest from this loan would be exactly $27,500, giving me a total of $82,500. The interest-only option generates almost double the amount of interest than an amortized loan would. Now, as my mentor told me, I'm going to tell you, you do the math and the math will tell you what to do. Well, if the math is proving to you that one way is more profitable than the other, then the decision should be obvious. I mean, who doesn't want more profit? But of course, like I said, these notes can be riskier than your traditional amortized loans. So don't forget to take that into heavy consideration. And if you need some help with your due diligence or how to structure these types of notes within your IRA, please book a time on my calendar, notenuggets.com/contact, or shoot me an email, kevin@notenuggets.com. There you have it. That's what you should consider when investing in interest-only mortgages. If you want to learn more from the Note Nuggets podcast and join the Note Nugget community, don't forget to subscribe to get episode updates and additional Note Nuggets to help you on your investing journey. You can subscribe to the podcast at notenuggets.com/subscribe. Thanks, everyone.
Thank you for tuning in to this week's episode of the Note Nuggets podcast. Be sure to subscribe to the show to get access to additional weekly value nuggets and get notified with episode updates. To subscribe, all you have to do is head over to subscribe.notenuggets.com. If you have any questions about this episode or note investing, book a time on Kevin's calendar at contact.notenuggets.com. We'll see you next week with another note nugget to add to your tool belt.